Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Monday, July 13th, 2026. We're Elena and Marcus.
And it is definitely a heavy morning out there.
Yeah, heavy is one word for it. I mean, you wake up and the world's most critical oil choke point is suddenly blockaded.
Right.
Inflation fears are just instantly reignited across the board. And on top of that, we're seeing this massive $5 billion trapdoor opening right under the semiconductor market.
Yeah, that is exactly what institutional desks are dealing with today.
So we have three critical themes emerging from today's proprietary updates, and these are basically rewriting the market narrative for the week. We need to lay out exactly what you can expect here. First, we are tracking a very sharp geopolitical energy shock stemming from the Strait of Hormuz,
which is driving a classic stagflation fear trade.
Exactly. Second, we're monitoring a highly aggressive, hawkish repricing in global rates. This is right ahead of tomorrow's crucial consumer price index print, and it was sparked directly by commentary from Fed Governor Waller today.
And third, there is this violent, idiosyncratic tech unwind happening. It's specifically concentrated in the semiconductor space.
But clashing with surprisingly resilient retail demand in the broader market, which is a really weird dynamic. So we're going to examine exactly how these forces are reshaping institutional positioning and what it means for your portfolio. Moving to today's data, we have to start with the bedrock of today's market architecture, right?
Yeah, the synchronized backup in global interest rates.
Right, because that is the gravity dictating the pricing of every single other asset class we're going to discuss. So looking at our latest run, the 10-year Treasury yield spiked 6 basis points today to 4.62%.
And simultaneously, you've got the 2-year climbing to 4.288%.
Right, so notice how the curve modestly steepened there.
Yeah, the long end of the yield curve outpaced the front end. And that tells us something very specific about how the bond market is digesting risk. There are really dual catalysts driving this rates back up.
The first one being the physical oil markets, right?
Right. This inflationary supply shock hitting oil, which we will get into shortly. But the second catalyst is Fed Governor Waller's explicit warning today.
Yeah, that was pretty blunt.
Very blunt. I mean, he stated clearly that the Federal Open Market Committee may need to consider near-term tightening if tomorrow's core CPI reading comes in hot.
Which completely reframes their reaction function.
It does. They go from this comfortable, data-dependent pause to being actively ready to hike rates again.
And the institutional flow confirms the market is taking that threat seriously. I mean, looking at our daily desk data, we observed heavy selling in August Fed funds futures.
Massive selling. Over 100,000 contracts traded today alone.
Yeah, and within that volume, there was a highly deliberate 33,000 block sold at 96.290. Let's translate that into plain English for you, because this is obviously not some retail day trader hedging their bets.
No, not at all. A block trade of 33,000 contracts represents roughly $1.4 million in basis point value.
So when you see that kind of size moving in the futures market,
it signals very deliberate, new short positioning from major institutions. You know, smart money is actively placing chips on the table that the Fed will be forced to hike.
Which means the market is now pricing a 43.3% probability of a July rate hike. That is up significantly from where we started the week.
Yeah, and this repricing is creating immediate international ripple effect, too.
Right, because during their trading sessions, UK gilts and European bunds just tracked U.S. Treasuries higher. The energy shock is a global phenomenon, so it instantly raised European inflation expectations.
Yeah, effectively pulling their sovereign yields right up alongside ours. When energy prices surge globally, European central banks face the exact same inflationary pressures we do.
Okay, let's pause here and apply the first principles rule. Because we throw around phrases like stagflation fear trade on the desk all the time. But how exactly does a simultaneous rise in inflation expectations and borrowing costs actually impact the portfolio of a regular investor?
That's a great question. Let's break down the underlying mechanics. So, stagflation is basically the painful combination of stagnant economic growth and persistently high inflation.
Right.
When supply shocks, like the one we're seeing in the oil markets today, drive inflation upward, central banks get trapped. Normally, if an economy slows down, the Fed cuts rates to stimulate growth.
To encourage borrowing, yeah.
But with persistent inflation driven by actual physical supply shortages, they simply can't cut rates. They have to hold them steady or hike, just like Governor Waller suggested today, even if it hurts the economy.
And for a regular investor's portfolio, that creates a massive dual headwind. Because first, higher borrowing costs immediately squeeze corporate profit margins. Companies have to pay more just to finance their daily operations and service their debt.
Precisely. And the second headwind is arguably more severe for modern portfolios. It drags down long-duration growth valuations.
So high-growth technology companies.
Right. Their value is largely based on massive cash flows they expect to generate years in the future. Mathematically, those future cash flows are worth significantly less today when they have to be discounted back to the present at a much higher risk-free interest rate.
So when the 10-year Treasury yield spikes, growth stock valuations compress mechanically.
Yes, which brings us directly to tomorrow's June CPI expectations.
Right. Institutional consensus currently expects a 0.17% month-over-month core inflation increase.
And based on our desk modeling, an upside surprise, say, something printing above 0.3%, that could trigger a massive downward repricing in equities of more than 1% across the board.
Cementing that July rate hike scenario into a near certainty.
Indeed. And that mathematical reality, that higher rates systematically crush future growth valuations, is exactly what we saw bleeding into the equity markets today.
We're not just seeing a broad market sell-off, though. We are tracking a violent, highly specific rotation out of momentum technology and into cyclical value.
Yeah, if you look at the broader index action, it reveals a really stark divergence beneath the surface.
Because the S&P 500 closed down 0.8%, but the underlying breadth is actually positive. 54% of S&P 500 names finished higher today.
Real institutional money is flowing actively into defensive and cyclical sectors like energy and utilities. But then you look at the semiconductor dislocation, which was the absolute epicenter of today's tech weakness, and it is a totally different story.
Yeah, the semiconductor index, the SOX, dropped 4.8% today. And the primary catalyst for this originated in the Asian overnight session, right?
It did. SK Hynix plunged roughly 15 to 17%. That was driven by an American depository receipt debut hangover, coupled with sudden concerns over artificial intelligence memory demand.
And Samsung dropped 10%.
Right. The Kospi index fell nearly 10% overall, which was so severe it triggered mechanical circuit breaker dynamics in Seoul.
Wait, let's make sure we understand the mechanics of the fallout there. Because our proprietary updates flag that this price depreciation triggered roughly $5 billion in notional sales from levered ETF rebalancing.
Yeah, it's brutal.
If you're a retail investor holding a triple-leveraged semiconductor ETF and the underlying Asian chip stocks plummet overnight, what exactly happens at the end of the trading day?
It becomes this vicious, self-fulfilling cycle. Leveraged ETFs use financial derivatives to amplify daily returns, right? So if the underlying index drops sharply, the fund's asset base shrinks, but their target leverage ratio remains.
So to get back to their mathematical ratio, say 3 times leverage, the portfolio managers are mechanically forced to sell assets right at the market close.
Yes, they're mathematically forced to sell into weakness just to comply with their own prospectus, which amplifies the downward pressure on the very stocks they track.
And we saw that exact pressure hit specific corporate movers stateside today. NVIDIA dropped 3.5% entirely in sympathy with that broader semiconductor rout.
However, not all large-cap technologies suffered the same fate. Apple actually rose 0.6%, aided by a newly filed trade secret suit against OpenAI.
Right. Investors clearly view that as a positive, aggressive defense of Apple's hardware moat.
And Microsoft gained 1.5%. Investors are treating their software and cloud businesses as safe havens, largely insulated from the physical hardware supply chain risks that are dragging down the chip makers.
Yeah, and moving beyond the tech sector, we saw highly significant action in the consumer and mergers and acquisitions space today.
Tapestry and Ralph Lauren faced a heavy, sustained unwinding of crowded, long positions. When rates rise and fear spikes, crowded trades are always the first to be liquidated.
Conversely, you have Ferguson gaining nicely following the announcement of a highly accretive $1.6 billion acquisition of Flowworks. That was executed at a very reasonable 10 times EBITDA multiple.
We also saw Aritzia post a remarkably strong quarter.
Right.
Comparable store sales were up 35.1%.
Which shows that specific consumer segments are still spending aggressively. But then you have Delta Airlines, right? They delivered strong earnings beats across the board, but the stock still completely grounded itself at the open.
Yeah, it traded down in a classic buy the rumor, sell the news dynamic. The good news was already entirely priced in.
That divergence across the consumer space is really telling. But looking back at the tech unwinding, we have to address the underlying market structure.
I agree. It raises a critical question about participation.
Right, like if semiconductors are getting crushed, momentum names are unwinding, and levered ETFs are puking assets, is the retail investor finally abandoning the market? Are we seeing a broad panic sell-off from everyday retail?
Actually, no. Our daily desk data explicitly refutes that idea. Retail demand remains exceptionally resilient overall.
Really?
Yeah, average daily net buying for July is currently running at 3.2 times the historical monthly average. Retail is still the strongest structural buyer of U.S. equities right now.
Okay, but they have to be showing some fatigue, right?
They are showing distinct targeted fatigue, specifically in semiconductors and hardware.
Meaning, if you have been conditioned for the last 18 months to just blindly buy every single dip in the semiconductor space, today's retail data is a massive red flag that the old playbook might be breaking down.
Precisely. They have been actively selling those hardware names on recent down days, which is a very rare departure from the persistent buy-the-dip behavior we have seen all cycle.
Wow, okay.
And furthermore, leveraged semiconductor ETF assets under management have contracted by 20% over the past week.
Falling from $218 billion down to $198 billion.
Yeah. The silver lining there is that it reduces the overall magnitude of those mechanical daily rebalancing flows going forward.
On that point, the defensive rotation into energy equities really requires us to examine the root cause of this entire macro shift, right? We have to look at the severe geopolitical disruption in the physical commodity markets.
We really can't understand the equity rotation without looking at the underlying hard assets driving the inflation fears.
So let's break down the massive crude oil move today. West Texas Intermediate, or WTI, surged over 9% to breach $78 a barrel.
And Brent crude jumped almost 11% to close over $83.
And the specific catalyst identified in today's data deck is a reimposed naval blockade on Iranian ships transiting the Strait of Hormuz. But what really amplifies the situation is a novel 20% tariff placed on all transiting cargo.
Yeah, the market is treating this as a true, sustained shortage threat, not just a transient shipping bottleneck.
We can see this panic reflected directly in the refining margins, right? Crack spreads widened significantly today to over $64 compared to their June lows of around $43.
To explain that briefly for you, a crack spread is a profit margin a refinery makes by buying raw crude oil and, cracking it into usable products like gasoline or diesel.
So when that spread widens by over $20 in a matter of weeks,
it indicates the market expects a severe supply constraint for refined energy products, which drives end consumer prices up. And this shortage threat extends directly to global natural gas as well.
Right. European natural gas markets are currently even tighter than crude oil. Our desk models are forecasting that the TTF, which is the benchmark European gas price, could rally all the way to 65 euros per megawatt hour.
And then we have the action in precious metals, which feels incredibly counterintuitive at first glance.
Yeah, gold pulled back nearly 300 basis points to $3,999, and silver dropped to $57.59. So, if geopolitical risk and inflation fears are spiking, shouldn't gold be breaking records?
You would think so, but it comes back to the mechanics of real yields, which ties directly into our earlier rates discussion.
Okay.
A real yield is the actual return an investor receives on a bond after subtracting expected inflation. Today, nominal interest rates rose much faster than inflation expectations did.
That means the real inflation-adjusted return on a U.S. Treasury bond spiked.
Yes. And since gold and silver are physical rocks that don't pay interest or dividends, they become mathematically less attractive to hold when you can get a higher risk-free yield just by sitting in U.S. government debt.
That makes total sense. That is the direct causal relationship. Rising real rates exert intense downward pressure on precious metal valuations.
Yeah, completely overriding their traditional safe haven appeal during geopolitical shocks.
But I'm looking at these industrial numbers and scratching my head a bit. If commodity prices are surging and physical materials are in demand, why are industrial materials underperforming the broader market today? What am I missing there?
It comes back to the margin squeeze we explored during the macro discussion. Rising 10-year yields fundamentally increase the cost of capital and financing for heavy industrials because they rely heavily on debt to build factories and buy equipment.
Oh, right. So you combine that rising cost of debt with surging energy input costs because it now costs far more to power those factories and transport goods.
Exactly. And you create an incrementally challenging macro environment. Heavy industrials are seeing their profit margins squeezed from both ends simultaneously.
Higher borrowing costs on the financing side and higher operational costs on the production side. and they simply can't pass those massive costs onto consumers fast enough to protect their earnings.
Understood. Now we must aggregate the rates backup, the equity rotation, and the commodity shock into a cohesive macro regime view for the listener. How do all these distinct moving pieces actually fit together into a broader market narrative?
Well, synthesizing the core message from today's proprietary updates, the market has fundamentally shifted over the past 2 weeks. We are transitioning out of an environment driven purely by passive positioning and systematic momentum flows.
Yeah, and we are returning to a true focus on fundamentals and specific stock selection. We can clearly observe this shift in the volatility anomaly right now.
Right. The spread between single stock volatility, measured by the VIG-CQ index, and broad index volatility, measured by the standard VIX, has reached a record high today.
At the exact same time, implied correlations across the S&P 500 are sitting at historic lows.
It's like we've stopped looking at the stock market as one giant school of fish moving entirely in unison. The correlation has broken. Now, every single stock is swimming on its own, living or dying, based purely on its own individual earnings merits and margin health.
Yeah, rather than moving uniformly as a single macro block, stock pickers are officially back in the driver's seat.
We also must look at the credit markets to confirm the underlying health of this transition.
Right, because despite the sharp equity sell-off in technology today, high-yield credit vehicles like the JNK and HYG exchange-traded funds and BB to CCC rated corporate paper have not blown out. Credit spreads remain highly contained.
Which is a crucial distinction. If the market truly feared a severe economic contraction or a recession, high-yield credit spreads would be widening aggressively as default risks rose.
But the fact that they're stable suggests the bond market views today's action strictly as a policy and inflation repricing event, not a systemic recessionary credit event.
So how does an investor actually position for this specific regime as we head into tomorrow's critical bank earnings?
The optimal expression in this environment is a classic barbell strategy.
Let's define that barbell. On one end of the barbell, you want to hold high-quality technology names whose valuations have finally reset down to their 10-year averages. Companies with bulletproof balance sheets that can survive higher rates.
Right, and you pair those with cyclical energy names on the exact opposite end of the barbell to act as a natural hedge against the ongoing geopolitical supply shocks out of the Middle East.
And in the middle of that barbell, you hold uncorrelated defensive assets like healthcare, which are largely insulated from both technology volatility and commodity price spikes.
And tomorrow's earnings reports from JP Morgan, Goldman Sachs, Citigroup, and Wells Fargo will serve as the immediate real-time test of this strategy.
Yeah, the major banks will give us the hard data on loan demand, net interest margins, and the actual health of the U.S. consumer. That will ultimately determine if this fundamental transition holds water.
Correct. The financial sector will be the leading edge of this earnings season, validating or rejecting the fundamental health of the economy.
But before we sign off, there is one more structural macro threat you need to keep on your radar as you process today's data. Consider that 97% of the S&P 500 is currently sitting in a corporate buyback blackout window.
Yeah, with corporations legally sidelined from purchasing their own stock right before they report earnings, the temporary removal of the market's biggest structural buyer leaves all of us entirely exposed to the raw macro volatility of tomorrow's CPI print.
There is just no corporate shock absorber left in the market to dampen the reaction if inflation comes in hot.
Exactly.
Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back tomorrow with the latest market color.